Welcome to vTalkInsight, Market Drivers Daily for July 23, 2026. Oil is trading just below the $100 mark. Yields are pressing toward new highs, and AI-heavy tech stocks are back under pressure. Together, those three forces are driving a rethink of inflation, rates, and equity leadership. Let us unpack how geopolitics, artificial intelligence, and central bank policy are intersecting in today's market. Middle East risk has moved back to the top of the macro agenda, with oil hovering just below the $100 mark and energy security again driving cross-asset pricing. The focus has shifted from refined product tightness earlier this week to visible threats at several choke points, turning what looked like a tail risk into more of a central scenario for many desks. Renewed drone and missile attacks by Houthi forces on Saudi tankers in the Red Sea, backed by Iranian pressure, are now threatening up to several million barrels a day of exports. Those disruptions are being compounded by worries around the Strait of Hormuz and fresh issues in the Black Sea, where the CPC pipeline has seen interruptions. Together, these routes carry a large share of seaborne crude, so every headline is feeding directly into higher risk premia. That is why Brent has pushed into the high 90s and briefly touched triple digits, with some houses now discussing paths toward $120 if both Hormuz and the Red Sea are severely constrained. At the same time, European gas storage is only about half full versus roughly 70% in a typical year, and regional gas benchmarks sit near multi-year highs. The combination of tight oil and fragile gas keeps stagflation risk firmly on the radar. In asset markets, the pattern is clear. European energy equities are among the few bright spots in otherwise softer regional indices, while sectors exposed to fuel costs, like airlines, are warning on earnings. American Airlines has flagged the possibility of a full-year loss on fuel, and banks such as BNP Paribas are quietly lifting generic provisions to reflect higher geopolitical uncertainty, even though observed credit losses remain benign. Defense names in the United States and Europe continue to beat and upgrade guidance as rearmament gathers pace. The counterpoint is that demand has been softer in parts of Asia, China in particular, and that previous supply shocks were cushioned by large stock draws and strategic reserves. Those buffers are now notably lower, though, and volatility in energy and freight could rise quickly if attacks escalate further or spread to new routes. Key watch points are whether Brent holds above 100, how far Saudi and United States policy can stabilize flows, and whether today's surprisingly muted volatility finally gives way to a more disorderly repricing. That backdrop sets the stage for how another energy shock interacts with the ongoing AI capex boom. AI remains the core structural growth story, but the tone around it has turned more skeptical. Equity markets are no longer rewarding sheer scale of spending. They are testing whether enormous data center and model budgets can deliver timely, high-quality earnings, especially against a backdrop of higher rates and more volatile macro conditions. Alphabet sits at the center of that debate. It plans to lift AI-related capital spending to roughly $25 billion this year and to ramp further into 2027, yet the stock fell after its latest update. Free cash flow has swung negative, and investors are questioning the pace of Gemini monetization and incremental cloud demand, even after a strong revenue and margin beat in the cloud division. Tesla shows a similar pattern. Reaffirmed AI and robotics plans above $25 billion in capex could not offset an earnings miss, and the shares are down double digits. Across the sector, heavy capex and lofty expectations are creating choppier trading. Hyperscalers such as Google, Amazon, and Microsoft are collectively set to spend over $200 billion each on AI infrastructure over coming years, and industry capex has grown roughly 75% annually for 3 years. Yet major tech indices are soft. Asian and European chip names can sell off on merely in-line results. And pre-market tone today is weaker as investors worry about margin compression and the timing of payback. By contrast, the picks and shovels layer is already seeing tangible revenue. Intel's data center sales have surged on accelerating enterprise AI demand. New rack-scale systems like Helios, alongside Venice-class processors, are in full production and delivering large efficiency gains for customers such as Anthropic, OpenAI, and Meta. Private market players that bet early on data centers and battery storage, like Blackstone, report strong earnings growth and successful multi-billion-dollar exits, while European infrastructure-oriented tech names benefit from robust AI and cloud orders, even as more consumer-facing segments struggle. The risk case is that this build-out overshoots end user needs. Chief financial officers are signaling tougher scrutiny over the next 12 to 18 months, with a focus on projects that clearly cut costs or grow revenue. Analysts talk about possible overcapacity in AI infrastructure, profit warnings if utilization lags, and an emerging asset bubble feel if leverage rises against uncertain cash flows. At the same time, AI is amplifying cyber threats and creating new fault lines in United States and China tech relations. Overall, AI is moving from a simple growth narrative toward a more nuanced return on capital story, which feeds directly into how markets price the cost of money in the next phase. Rates and currencies are being pulled by two powerful forces: an energy shock that threatens to re-accelerate inflation, and an AI capex cycle that has not slowed despite higher borrowing costs. Together, they reinforce the sense that the post-crisis era of near-zero rates is over, and that the cost of capital is likely to stay structurally higher than in the previous decade. In the United States, yields across the Treasury curve are back at, or near, their highs for the year. 10-year bonds are trading around 4.7%. 30-year yields are near 5.2%, and the 30-year has spent almost a month above 5%. 2-year yields have climbed to their highest levels since 2025 as markets price the risk that the Federal Reserve may resume rate hikes if energy-driven inflation persists. Implied odds of a hike at the upcoming meeting have moved into the mid-30s or higher, and near-term pricing now assigns a greater probability to an increase than a cuts. The data make it difficult for the Fed to sound dovish. Recent inflation contributions from tariffs and AI-related chip costs, combined with higher oil and fertilizer prices, are lifting headline and raising concerns about spillovers into core. At the same time, initial jobless claims have fallen to their lowest level since 1969, signaling a very tight labor market. Policymakers have responded by dialing back explicit forward guidance and stressing that each meeting is a live, data-dependent event, even as some argue that current inflation remains largely supply-driven and warn that tightening into a supply shock could backfire. Europe faces a similar but more growth-sensitive version of this challenge. Rising oil and gas prices, coupled with low gas inventories, have pushed German front-end yields sharply higher and led markets to price in further European central bank hikes. Brent's move toward $100 has already complicated the ECB's disinflation narrative and prompted more detailed scenario analysis. Yet policymakers also flag modest euro area growth and downside risks, raising concerns about over-tightening from levels that may already be near neutral. In Japan, by contrast, the central bank's cautious approach has left the yen weak, with markets skeptical that incremental hints of faster hikes will translate into meaningful tightening. These cross-currents show up clearly in assets. Major equity indices like the S&P and Nasdaq are down around 1% amid higher yields and geopolitical stress, with tech and other long-duration sectors bearing the brunt. Traditional bond allocations are proving less effective as hedges when both rates and inflation risk rise together, and commentary increasingly describes a new macro regime of structurally higher inflation, elevated rates, and persistent fiscal deficits. At the same time, the dollar has regained safe haven status, supported by resilient United States growth, higher yields, and ongoing geopolitical tensions. From here, the key questions are how far this rate's repricing runs and how central banks respond if oil stays near triple digits, which will be central to cross-asset positioning over the coming months. To sum up, an energy shock centered on Middle East supply routes is pushing oil back toward $100, reinforcing stagflation risks and supporting energy and defense-related earnings. At the same time, the AI investment cycle is maturing from pure growth enthusiasm to a more demanding focus on cash flow and return on capital, with infrastructure suppliers seeing clearer benefits than the large platforms funding the capex arms race. Those two forces are feeding directly into a global rates repricing, with the United States and European yields back near their highs, policy set firmly to data dependence, and the dollar regaining safe haven status. This video is for information only and is not investment advice. If you found this video useful, Please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.